Hello everybody, I've got Gary with me today before the end of the year. Before I speak to him though, I'd like to thank you all for tuning in and also thank everybody that joined us for the client seminars earlier in December. Seems a long way away now, but that's where we are with time flying. Gary, hi. I've got a few questions from the seminar that I'd like to put to you, if we may, to bring the year to a close. First one from Clayton, thanks Clayton, is Rishi Sunak doing a good job?
I think the general answer on that has to be yes. I think the government have not done a bad job for the last 2 years. Let's face it, if we knew today, and we could turn the clock back to December 2019, and we knew what was about to come, would any of us want to be in any position of authority in the country? I think only the insane would answer yes. But I think where you look at the areas where the UK has got a lot of credit, it's in two key points. The way in which we have kept people off the unemployment records. In other words, people have still been getting money and they've been able to conduct some form of life during lockdowns. And that's really due to the furlough scheme and the rapid response of the Treasury under Rishi Sunak. And the second area was in the vaccine rollout, where we've been very strong. So I think you have to give Rishi Sunak a lot of credit. If I'm going to level any criticism at the government, it's the contradiction between what they want in terms of more investment in the economy and what they've done with the tax policy. So if you want companies to invest more, don't put up corporation tax. To say that corporation tax is going to go from 19% to 25%, a 6% increase, is not the way in which you get companies investing more. Because what you're saying is invest the money, but we're going to take the future returns away from you in terms of additional taxation. So I wasn't impressed with that. But one has to say that overall, I think Sunak has hardly put a foot wrong through this pandemic.
Thanks, Gary. This leads nicely into the second question, actually, which is all about the pandemic. And when do you and the investment team think that this whole thing will have worked its way through the economic system?
When this came upon us, really in March of 2020, as a team, we are looking for data to help us with our decision making. So we looked to the type of data that was available to us, and we found 3 pandemics in the last 100 years, 2 of which have really slipped by almost unnoticed, and then one, the Spanish flu of 1918, obviously very different to COVID-19, but it gave us some idea of what happens during pandemics in recent times. And it also meant we did a bit of reading up on pandemics, and 1 or 2 friends of mine who are doctors gave me some interesting pointers and some good information, including enabled me to sort of log on to a talk by Professor John Bell, who's a very, very senior epidemiologist. And what is consistent with pandemics, and this is how one doctor friend of mine put it, that viruses don't kill you deliberately. In fact, they don't even know they're doing it. What they want to do is survive. And they survive if we survive. And then they want to be transmitted. So the longer they can keep the host alive, the better it is for the virus. So a virus, as it evolves, will tend to evolve and be more transmissible and less deadly. That's the smart virus. So Omicron is in many ways what you would expect a clever virus to do. And another doctor friend of mine described COVID-19 as an extremely clever virus. Now, if you look at the data available and you look at Omicron hitting South Africa, it shot up very quickly in terms of the levels of infections. And then it started dropping equally as quickly. We've probably not hit the peak yet, but we're not far off it. But if these estimated data is right, and so let's take London, which seems to be the centre of Omicron, that between 1 in 10 and 1 in 20 of the London population was infected at one time. That's between 5 and 10% of the population. Then it was running rife through the country, and hopefully that means a lot of people are going to pick up antibodies and immunity to future versions of COVID-19. So this could be the blowout. Either way, what you're seeing is the vaccines have proved very effective, and I suspect that we're at the tail end of this now. So I'll give myself a get out and say, this is a prediction subject to nothing else happening that disrupts the economy. But I think we're going to come to the end of it during 2022. Now, one has to be careful with this because 2020 and 2021, despite the pandemic, were not bad years for capital markets. So we made good money for clients in those 2 years. You may go back to normal and find you get wobbly stock markets. That's something else I'm not predicting, by the way. But I just think, you have to be very careful. If the question is a line saying, how well will markets do? They've probably got nothing to do with the way in which Omicron comes to an end, assuming that it does. But our outlook for 2022 is quite positive.
Thank you, Gary. Thank you, Derek, for that question. Gary, moving on to Courtiers. One question that we had from Professor Mitchell is, how will your three-part strategy differentiate Courtiers from your competitors? And to remind everybody, that three-part strategy was A, keep duration short, B, buy assets at reasonable prices, and C, diversify. Can you elaborate?
So the one that sets us apart probably more than anything else at the moment is short duration. And duration simply means you're removing the interest rate risk to your bonds. So we have to hold a certain amount of bonds to reduce risk, but particularly for cautious investors, and the same for balance. In the growth fund, we don't need to keep any bonds at all. People tend to invest in real assets and want above average appreciation in that fund, so it takes a bit more risk. Obviously, there's no bonds in either of our two equity funds, and there is bonds in our investment grade bond fund. So what probably distinguishes us from the rest is that we keep duration very short. We don't get into this habit of thinking, or this trap of saying, oh, because everybody holds a certain amount of 20-year, 30-year bonds, you've got to hold them. Absolutely not. We don't like holding bonds. At one stage in December, you could buy them, with a yield of 0.75% for 10 years. Now, we think that's very bad value when inflation is running significantly hotter than that. And it's the same with 20, 30 years. So what I think interest rates will normalise. We've already seen the Bank of England make one move in that direction. For me, they've jumped the gun a little bit too quickly, but that was something that worried me a bit with regard Bank of England policy, that they would be driven by immediacy instead of thinking of the long term and letting themselves find out what inflation really is effective in the economy at the moment. But what we've done is taken bond duration risk out. That makes us very different from the average competitor, and we know we tend to perform differently to our peers when interest rates are moving up or down. When they move up, we tend to outperform. When they move down, we tend to underperform. And I'm completely happy with that. Very happy. Then the second one, I think you said, was buying from the seminar, was buying assets at reasonable prices, something you should also always do. Anyone who wants to really understand how an analyst should behave should read Benjamin Graham's 1934 classic Security Analysis. And he is relentless on buying assets at reasonable prices. This is what's made Buffett one of the richest men in the world. He will not compromise his standards and drift into buying an asset that is trading on massive PEs. So we stick with that very, very carefully. And number three is diversify, which you have to do. So, for example, one of the questions came up during the seminars. We had a number of stocks that did very well during the year. We'd made money on Royal Mail, Reach, a Mirror Group. Lots of others did very well, particularly the banks. One that didn't do well was Go Ahead Group, and it got hit by an accounting scandal, and that whacked the share price. And that is why you diversify, because there was no evidence of any shenanigans in the accounts. You couldn't have spotted that unless the only person that would have known that was the crook that actually falsified those books in the first place. But you diversify because you can't put all your eggs in one basket in case something unforeseen happens, and we will always do that. So we have good diversification. We've got good assets at reasonable prices. You won't find the Courtiers portfolio heavily weighted towards the big expensive tech companies, and we've taken most interest rate risk out because our predictions are that interest rates are going to move back up, and that's going to be a disaster for long-term bonds.
Thanks, Gary. Just on that, buy assets at reasonable prices, you mentioned their PEs. Is that a price to earnings ratio?
Oh, sorry, yes. So if you like, it's the number of times your net profits go into the price you paid for the stock. So if a share has got a net profit of 10p and you pay £1 for it, that's a PE of 10. That's actually not bad, because that means your earnings yield, put it another way, your earnings yield is 10%. Well, the UK market trades something around 14 to 16. US market trades at around 18. The S&P's trading around 22 at the moment, i.e. the US market. But some of the expensive companies are trading at 35, 36 times earnings, and some of the cheaper ones at the early teens. So one of the things we found, and just out of interest on this, and going into 2022, what we think will be a theme, is you've got to pick your stocks carefully. Don't get sucked in to overpaying for things. Look for the hidden gems and the things you can buy at reasonable value, because you then get a margin of security if things do go wrong.
Sounds like you and the team are set out for 2022, much as I feel myself with the communication streams are. Gary, just one more quickly, if I may. Excuse me. Again, from Professor Mitchell. He says that Courtiers has grown quickly and substantially. How can you continue to do so?
We've grown quite steadily, actually. I don't think you can say that the Courtiers' growth has been meteoric. It's certainly been strong over the last 15 years. I think there's a classic way of going about growing. It's a bit the way we do our stock selection. You find good businesses, you acquire them, you make sure you employ good people, and things go on. So Jamie and I have a couple of phrases that we use, and when the acquisition work is being done, which I will add, he does the lion's share of that and does a thoroughly good job doing it. And that is that we say no Trojan horses. And what you don't want to do is see something outside of Courtiers that looks all lovely and attractive, buy it, bring it into the company, and as it unfolds, it just rots you from the inside. So we're very, very careful. You know, we say no much more frequently than we say yes, and Jamie's very patient on his acquisitions, and we've grown nicely to that. And the wonderful thing is we've bought some great companies with some great people, and they continue to make a big contribution towards Courtiers' future. So I would say, Leo, for us, it's more of the same, because it's worked extremely well, and we eat steadily. It's not that we've tried to double our size in a short period. That's not been the case. We've grown quite steadily over the last 15 years or so. So yeah, I think for us, more of the same. Buy good people and let them get on with working the way they do well, and keep your structures tight, and yeah, and it works.
Invest carefully.
Yeah, invest carefully. I mean, it's exactly the same. But when Jamie's going around buying companies to bring into Courtiers, he's using exactly the same types of approach that we use when we're buying stocks for our investors' portfolio, which is look very, very careful at the business, do your homework on the figures, and work out how they're going to fit into the portfolio. And if you do that, then you know, most of the time you're going to make good decisions. And if you make bad ones, and it's not happened very often, I think we've had one acquisition that backed out, it just didn't work in the end. But both parties parted, and aside from that, it's been a good period for us. So yes, more of the same.
Thanks, Gary. Watch this space. Before I close down, Gary, are there any other messages or anything else you'd like to say to our viewers?
Well, the one I'm asked more often is, what do I think is going to happen in 2022? And I go through this. You have a bit of time off over Christmas, and you think a lot about things. And every time you go into a new year, you're always trying to say, where are the risks going to be? Where are the risks going to be? And then, they come at you in different ways. If we were having this conversation in December 2019, I was not seeing a global pandemic hitting markets. Going into this year, probably say that there's the chances the global pandemic will pass, as I said earlier. And so you're mindful of where the other risks will come from. There's a lot of very interesting things happening in markets, but I think you've got to do your work and take a macro view and look at what's happening in the world. And there is certainly a big move towards sorting out global warming and renewable energy. And you have to be very careful, I think, if you're going into stocks that are not on board with that theme. So I would not be buying anything that's a polluter that's making no apology for the pollution. If they're just a company just trying to buy up coal mines and whack the profits through for a few years, we're not going to be anywhere near that. But there's lots of other interesting opportunities in this green area now, and we covered some of those at the seminar, and no doubt we'll be covering them in 2022. So lots of opportunities, Leo. Lots of exciting things. Hopefully, the UK economy. A recent forecast was that the UK economy was looking to do quite well going forward, which is excellent, and overall generally quite positive, but not complacent, because you're always mindful of where the risks are going to come from.
Thanks, Gary. And all I've really left to say is Happy New Year to everybody. And Gary, Happy New Year to you.
Thanks, Theo. And to all clients, thanks for entrusting us with your assets during 2021. Thank you for logging on to the client seminar, and for those that turned up, it was great to see people in person, and look forward to catching up with people next year with all these wretched restrictions and lockdowns gone, hopefully for the rest of my lifetime. That would be perfect, wouldn't it?
We've already got our seminar dates locked in, and we'll be in touch quite early next year with invitations, so stay tuned for that one. Gary, I will look forward to seeing you and working with you in 2022.
Thanks, Theo.
All the
Happy
best.
New
Bye.
Year.
Happy New Year.